Hello everyone and welcome to Financial Accounting. In this video, we will talk about the revenue recognition principle and the 5-step approach for recognizing revenue. Revenue recognition is one of the basic principles of accounting. The revenue recognition principle requires that companies recognize revenue in the accounting period in which the performance obligation is satisfied. What is a performance obligation? A performance obligation is a promise to deliver goods or provide services. When a company agrees to perform a service or sell a product to a customer, it has a performance obligation. When this performance obligation is satisfied, it's time to recognize revenue. Therefore, the revenue recognition principle requires that companies recognize revenue in the accounting period in which the performance obligation is satisfied. Let's look at an example. Assume that Johnson's Landscaping Company provided services to the customer on June 30. The customer pays for the work on July 1st. Johnson Landscaping should record revenue in June when the company performed the service, or in other words, satisfied the performance obligation, rather than in July when it received the cash. On June 30, Johnson Landscaping would report a receivable on its balance sheet and revenue in its income statement for the landscaping service provided. Let's get into more details in the next example. Assume that Delta Corporation signs a contract to sell a production line to its customer, a manufacturing company, for $100,000. Let's use the 5-step of the revenue recognition approach to decide when revenue for this contract should be recognized. Step 1. Identify the contract with the customer. A contract is an agreement between two parties that creates enforceable rights or obligations. In our example, Delta Corporation has signed a contract to deliver a production line to its customer. The second step is to identify the separate performance obligations in the contract. In our example, there is only one performance obligation to deliver the production line to the customer. As the customer decided not to purchase any training, maintenance, or extended warranty, there are no additional performance obligations that Delta Corporation is required to deliver. If you would like to look at an example of revenue recognition for a contract with multiple performance obligations, I would recommend watching the video Revenue as a Contract and Performance Obligations. In that example, the automobile dealer sold a vehicle together with 3 years of services and 2 years of extended warranty. I'm posting the link here and in the description box. The third step is to determine the transaction price. The transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring goods or services. In our example, it is very easy to determine the price. It is $100,000. Step 4 is to allocate the transaction price to the separate performance obligations. Since in our example there is only one performance obligation, no allocation is required. Step 5 is to recognize revenue when each performance obligation is satisfied. In our example, Delta Corporation recognizes revenue of $100,000 for the sale of the production line when it satisfies its performance obligation of the delivery of the production line to the customer. Many transactions are straightforward and don't cause problems with revenue recognition. At the same time, it might be very difficult to recognize revenue, particularly when there are multiple performance obligations that are satisfied over time. You often see it in service arrangements or in the case of long-term construction contracts. I will cover revenue recognition issues in more details in separate videos. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button, and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.